Hi, I'm Takanobu Mizuta from SPARX Asset Management. Today, I'm going to give a presentation under the title Instability of Financial Market by Optimizing Investment Strategies Investigated by Agent-Based Model. You can download this presentation material from this URL. This is a table of contents. First is introduction. Second, I will explain our model. Third, I will show the simulation result. And lastly, I will summarize. Introduction. Most of financial studies are discussed on the basis of several hypotheses. However, the hypotheses themselves are sometimes criticized. One of them, the rational optimization of investors' investment strategy, is also criticized. There are many reasons, but in this talk, I will treat this reason. Impossibility of handling market impact, where trades of investors can impact and change market prices. In backtesting, also make optimization impossible. In backtesting, investors' profits are estimated if they were trading at past market prices. I will estimate using these figures. For example, this blue line is a past time evolution market prices, but in backtesting, this was fixed and unchanged. Here, if they were buying this time under fixed time evolution, in actual financial market, the trades impact market prices and market prices will be changed. But in backtesting, market prices are fixed. So in the fixed time evolution, under the fixed time evolution, they calculate how much profit. And in this time, if they were selling here and fixed time evolution, how much they earn. So in fact, there is no method to exactly estimate the market impact before trading. So investors cannot estimate their earnings, including the effect of their market impact. I will explain what is optimization instability. Optimization instability causes not only market prices, but also the parameters of investment strategies to continually change. The optimization instability is one level higher than non-equilibrium of market prices. The mechanism is this here. At first, an investor selects the rational strategies at that time, so they optimize the parameter of investment strategy. This is a micro process. From this, they trade, and these the trades change the time evolution of prices. This is a macro process. The time evolution of prices are changed, so the rational strategy is no longer rational. This means optimal parameter of investment strategy is changed. So the investor again selects a rational strategy, the different optimal parameter of the investment strategy. So the loop is continuing. So optimization instability caused by this micro-macro feedback loops. Non-equilibrium of market prices like this. Of course, market prices are non-equilibrium, but it is possible that a parameter of investment strategy is stably optimized. On the other hand, a higher level of instability, optimization instability is a parameter of investment strategy is changing irregularly and unexpectedly. So market price is of course non-equivalent and unexpectability moving. An empirical study cannot handle market impacts. We cannot actually trade with large impacting. An empirical study cannot separate the causes of changing market prices, whether by the time evolution or market impacts. An actual market model, this is agent-based model for financial markets, can handle the market impact. An actual market model can fix other factors than market impacts. Only an actual market model can effectively handle micro-macro feedback loops. So, no actual market study optimizes investment strategies in which an agent searches one optimized parameter in whole simulation run in economics and financial studies, and no model determined whether only market impact leads to optimization instability. Therefore, in this study, we built an actual market model, agent-based model for financial markets, by adding technical analysis strategy agent, TAs, which search one optimized parameter in a whole simulation run to the priority model of Mizuta 2016. The TAs are momentum TA, TAM, and reversal TA, TAR, and we investigated whether investors' ability to accurately estimate market impact in their optimization leads to optimization instability. An actual market model is a virtual and actual market built on computers. The models include the agent, actual investors, and the price mechanism, actual exchange. An agent, each agent determines an order by some very simple rules, and the price mechanism gathers agent's order and determines market prices. So this is a complete computer simulation and not needing no empirical data. Actual market model can effectively handling micro-macro feedback loops. This is a strong point. Next, I will explain our model. An overview of my model. In this study, the actual market model was built by adding the two TAs to priority model of Mizuta et al. 2016. There are normal agents existing, thousands of agents to replicate the nature of price formation in actual financial markets. I introduced the normal agents to model as general investors. And there are two TAs, TAM and TAR. Two TAs, technical analysis strategy agents, search their one optimized parameter to a whole simulation run. TA's details will be shown later. This is a stock exchange price mechanism. We employ the continuous double auction as a price mechanism. Multiple buyer and seller compete to buy and sell stocks in the market, and the transaction can occur at any time, whether an offer to buy and an offer to sell match. This is a very normal in actual financial market. Normal agents. All normal agents use this same equation to obtain expected return. However, because W is different each agent, expected return are different each agent. This is heterogeneous, although the model is simple. The first term is representing the fundamental strategy. Second term is technical strategy, and the third term is noise. The first term represents the fundamental strategy. The agent expected the positive return when the market price is lower than fundamental value. Red line is a fundamental price blue line is the market price, and when market price lowers the fundamental price, the agent expect a positive return to converge to the fundamental price. So expect positive return. On the other hand, when market price is upper than the fundamental price, the agent expect converging to the market prices, converging to the fundamental price, so expected negative return. On the other hand, the second tab, technical strategy, when historical return is positive, the agent expect continue to this tendency, so expect positive return. And historical return was a negative. The agent expected to continue the negative return, so expect a negative return. After the thousandth normal agent place an order, the TAM and TAR place order in this order when the following conditions are satisfied. For example, TAM current market price bigger than the historical market price. TAM holds 100 shares. This is a momentum strategy because the historical return is positive, so hold 100 shares. On the other hand, historical return is negative. TAM will short sell 100 shares. On the other hand, TAR reversal strategy, historical return negative, hold 100 shares buy. On the other hand, historical return is a positive, short sell, reversal strategy. And TM and TR is parameter should be optimized to earn the best by backtesting. So these parameters are optimized by backtesting. TAs optimizing the parameter. First simulation run, TAs do not participate, and there are only normal agents, and the normal agent make the time evolution by market prices. After the first simulation without TAs, TM and TR are optimized to earn the best by backtesting using this time evolution of prices. And next, second simulation, TAs participates using TM and TR optimized by first backtesting, but prices are changed from first simulations because market impacts of TAs and normal agents have exactly same parameters, but normal agents trades are different from the first simulation, and so the time evolution of prices are different. And best TM and TR is also different, so they should optimize again. And TM and TR is a change, so the third simulation fixed normal agent means that all parameter in the blue circle is exactly fixed, but at market prices, time evolution of market prices are changed by TA's market impact. So these parts are changed. So expected return of each normal agent is changed. Profit of TAs has a very complex dependency for TM and TR. So finding minimum minus profit, so max profit is this way, is very difficult. So PSO, particle sum optimization, is a good solution. in the PSO, there are many particles and they are put to both their each historical base. For example, this particle put this way. This is a historical base position for it. And they are all historically based. For example, this one. So this particle pulled to this way and this way. And this particle pulled to this way. So thanks to many particles that are rarely trapped into a local solution, for example, here and here. Next, I will show the simulation result. This figure shows the time evolution of the prices with the TAM and without it. In the case without TA is very stable, but with TAM very oscillated, amplitude very large. So the existing of the TAM enlarged the price variation. This figure shows the TM for simulation runs, a number of simulation runs and the profits of TAM. TM never converged to specific value but changes in cyclic manner, oscillated. The optimization of TAM strategy is unstable. First simulation without the TAM, time evolution of market prices makes and but TAM backtest and TM is optimized. Second simulation, trades of TAM change the market prices, so time evolution of market prices are changed. For third simulation, for backtesting, TM is re-optimized and to another value. So TM is changed and TM is cycled and never converged. Strategies of trades are never reach the equivalent, and the optimized parameter of strategies are never fixed in time. As that loops exactly corresponding to the this loops micro macro feedbacks I showed before. Even if all other traders are fixed, only one investor optimizing its strategies using backtesting leads to time evolution of market prices becoming unstable. So financial markets are essentially unstable, and naturally, investment strategies are not able to be fixed. The reason is that even when one investor selects a rational strategy at that time, it changes the time evolution of market prices, it becomes no longer rational. So another strategy becomes rational and the process repeating. This figure shows the TM and TR with both the TAM and TAR. The changes of TM and TR were irregularly unexpected. So the time evolution of market prices produced by investment strategies having such unstable parameters is highly unlikely to be predicted and have stable laws written by equations. This nature makes us suspect that financial markets includes the principle of natural uniformity and indicates the difficulty of building an equation model explaining the time evolution of market prices. Both TM and TR do not return to the certain historical values, or the changes of TM and TR are irregularly and unexpected, so very chaotic situation. This figure shows the profits of TAM with only TAM and with both TAM and TR. Usually, people say investors still another investor's profit, so zero-sum games. But this figure shows this is not true. TEAM and more than that without TAR. So profit of one strategy is not stolen by the another strategy, but both strategies increase their profits. So there are two strategies cases, the TAM and more. This result is consistent with the previous my study with the 2021. Conclusion. In this study, we built an actual market model by adding technical analysis strategy agent TAs, which search one optimized parameter in a whole simulation run to the priority model Mizuta 2016. The TAs are momentum TA, TAM, and reversal TA, TAR, and we investigated whether investors' instability to accurately estimate market impact in their optimizations leads to optimization instability. When both the TAM and TAR exist, the parameters of investment strategies were changing irregularly and unexpectedly. This means that even if all other treasures are fixed, only when investor optimizes its strategies using backtest leads to the time evolution of market prices becoming unstable. Financial markets are essentially unstable, and naturally, investment strategies are not able to be fixed. The reason is that even when one investor selects a rational strategy at that time, it changes the time evolution of market prices. It becomes no longer rational. Another strategy becomes rational, and the process repeats. Optimization instability is one level higher than non-equilibrium of market prices. Therefore, the time evolution of market prices produced by investment strategies having such unstable parameters is highly unlikely to be predicted and have stable laws written by equations. This nature makes us suspect that financial market includes the principle of nature uniformity and indicates the difficulty of building an equation model explaining the time evolution of market prices. That's all of my talk. These are differences. Thank you very much.